Hello and welcome to our online videos. You're watching this video because you received one of our short videos that discusses second liens being larger than your first liens and how that affects your loan modification. Well, this is the most trickiest of loans to have modified under the Making Homes Affordable program. Let me explain to you why. The Making Homes Affordable program takes into account your gross income versus your housing expense. That ratio needs to be 31%. So your housing expense cannot, once your housing expense is 31% of your gross income, they have helped you. And they'll lower your interest rate until that happens. Now, the other videos we have explains how that works a little more, but this is the thing. That 31% only takes into account your first lien. So basically it's your principal balance, interest, taxes, insurance, and homeowners association if you have it. The trick is it's principal and interest of your first lien only. That entire summation or obligation per month, if once it is lowered to 31% of your gross income, you are now satisfied under the Making Homes Affordable program. Now, there's other things to consider as well, but when that happens, you have satisfied one of the requirements. Well, what if your first lien mortgage is only $80,000, but your second lien, because you took a line of credit, is $150,000? Well, that's a problem because now your back-end ratio is going to be astronomically high. You're still negative, and you still can't afford your mortgage. So while you may be able to get a modification on the first, your real problem is the second lien. Well, in the second lien, the Making Homes Affordable will never modify it under the first lien program. So now you have to turn into the second mortgage lien program under the Making Homes Affordable. Now, not every bank is doing the second lien mortgage. This is the issue with this. When your second lien is your biggest concern, you need to address it right away because most second lien mortgages are variable interest rates. If you have a variable interest rate, what's going to happen? In 3 to 4 years, whatever interest rate you have now, since it's variable, it's going to go up. It's going to go up a lot. We expect all interest rates in about 4 years to 5 years to be well into the two-digit numbers, anywhere from 10 to 15%. It happened in 1980, and it'll happen again. All indicators show that we will have inflation. It has to happen. If you understand economy, you will understand how this will happen, and there's no other way around it. So what happens? If you have a variable rate mortgage, you need to address that. If they don't help you, regardless of whether you got a modification on your first, if the second doesn't help you, and they are forcing foreclosure on you because maybe your first lien is so low that it would benefit the second to pay off the first, foreclose on your house, and sell it. If that happens, the second lien, in those few circumstances, they will foreclose the house if it's profitable to them. Either way, if your first lien is so low and your second lien is an issue and they will not help you and keep you with a variable rate, they'll say to you, well, you know, call us in 2 or 3 years. If once your interest rate increases, we'll help you then. So basically what they're telling you is this: don't worry and trust us that we will help you if it starts to go up to a certain amount, whatever that may be. So maybe you call them in 3 years when your interest rate went up all of a sudden to from 3 to 6 or 7%, and now your payment's doubled. So they say to you, sorry, we can't help you. Now, why wouldn't they help you? 2 main reasons. One, in 4 years, things may be better than they are today. People are working again, the banks are lending money again, the house values are starting to go up slowly, so they might say to you, sorry, we're not going to help you because we're not. Foreclose if you have to. You know how I know they'll do this? Because 5 years ago, that's exactly what they used to do. I've been doing short sales and modifications to a very minimal degree beyond 5 years ago. And that is exactly the attitude these banks had. The reason they're helping us now is because they have to. There's so many defaulted loans, plus they had help from taxpayer money. So they're helping us out because they have to. When the tide changes again, they're not going to be so willing to help you, and you will be damaged. So you need to make a decision today. If they are not willing to help you on that variable rate second lien, you need to make a decision if you want to sell that house and cut your losses now. Because if you don't, you may be forced to sell that house in 4 or 5 years, and now it's 5 years later when everyone is doing well, but now you are defaulted on your mortgage, so now you're the bad guy. I prefer the banks to stay the bad guy. The tide is in our favor now. Let them be the bad guy. There's a lot of people having difficulty, and if your decision or the decision that you have to make today is to get rid of your home because the bank will not help you, this is what you need to do today, because in 3 to 4 years you're going to be okay. It would be a shame for you to hold out 3 or 4 years, struggle, and then be faced with a foreclosure because your second lien went straight up and now it's 7–8%. Now, if they're not willing to help you, submit the modification. If they're not willing to help you, this is a decision that you need to make because it could really damage you. So I hope this video explained the implications of having a high second lien mortgage. Now, on those files that we put together for our clients, we explain this to them and we address it with the banks immediately. We do have a kit that we offer that where we put the file together, but you do all the dealings. We do have videos to help you every step of the way, but you basically go through and put the file and negotiate with your bank with our help. But we do put the file together for you because we know, based on the bank and kind of investment that you have on your equity line, how you should present it. But I've got to tell you, if they are not willing to help you, it is time to make a decision and possibly even short sell that house. I know this isn't great news, and I know this isn't something that you would want to hear, but it is the best option for you, because if you are just hoping for the bank to help you in the future, once the interest rate increases, you're going to have difficulty. And finally, one thing to consider. If they tell you, come to us in a few years if the interest rate gets too high for you, where you can't afford it, guess what? By the time the interest rate gets too high, it's too late. Because that means that the market rate or index at that point in time, if it went from 3 to 7%, is 7%. So the solution they're going to give you then is, well, sir, the best I can do is give it to you for 7% because that's what the index is. Well, now what? They can't give it to you for 3 again because that's not the index. If the index is 3, they can, but not if it's 7. So the best they can give you is, well, we will fix it at 7, but you have to pay 7 for the life of the loan. And then you're going to say to them, yeah, but I can't afford over double the payments now. So that is the implication. So take into consideration, I do hope this helped you, and you will get the rest of our videos on email, and you can link it and watch other videos that we have that explains other things about loan modifications and how it affects you. And good luck to you.